Hello and welcome to today's daily market recap. I'm CMS Forex market analyst Nick Nassad. Today is Thursday, January 21st, 2010. The dollar and other currencies dropped sharply against the yen in today's trading as we had concerns over proposed U.S. banking regulations, continued worries over Greek sovereign debt, and a possible slowing of Chinese growth, which led investors towards the safe haven of the Japanese currency. The Obama administration proposed new regulations on banks, which would force institutions to choose between either being a commercial bank or proprietary trading for their own profit, and it also seek to limit the size of mega banks. The news reverberated throughout U.S. stocks, and the Dow Jones Index was down 2% at today's close. Overnight, the greenback had rallied against some of its other rivals as China reported its GDP had expanded at 10.7% in the fourth quarter of last year, which was up from the 9.1% it saw in the third quarter, and Beijing also disclosed that inflation had risen as far as 1.9% instead of increasing to only 1.7% as expected. That Chinese data signals that tighter policy may be just around the corner as Beijing seeks to prevent its economy from overheating. So that increased some risk aversion in the currency markets and hurt the currencies such as Australian and New Zealand dollars. In a look at the dollar-yen pair, we see the sharp reaction as U.S. stocks responded to the new administration's proposed bank regulations. So we had a sharp 160 pip slide after we tested the 91.85 area coming into the New York Open, and we found support near 90.10. This large drop wiped away the gains the greenback had seen against the yen, starting here with Tuesday's low around 90.30. And if we zoom this pair out, we can see that today's support also came, if we draw our downward sloping support trend line there. We'll see if there's a further move down in the pair in the last trading session of the week, or if perhaps we see a bit of a counter rally to the sharp reaction that we did see before this pair extends any declines. The euro yen, which has been on the back foot all of this week and last week, fell sharply as well. From a high around 129.50, we slid 230 pips to a low near 127. Zooming out, we see that we moved slightly below this low we had on December 18th, which pretty much acted as support in today's session. If we zoom out slightly further, we see that we had another low in November 27th, which is the support that we're going to be looking at now for the pair to break or to bounce up off of. In a third look, here the Aussie yen pair, we see again a very sharp reaction in the wake of the proposed bank regulations from the US. So here there was another 230 pip move from high to low in today's session. We broke below support here from yesterday around the 82.80 level, and we found support at 81.30. The euro-dollar pair had a bit of a choppy session today. We did fall below our support from yesterday around 1.4080, but we found support, a new support at 1.4035. Here, the greenback gained as we had some weak data, fundamental data coming out of Europe, as well as the continued concerns about Greece debt. A spokeswoman for the European Commission said Thursday that she wasn't aware of any financial bailout packages being arranged for Greece, which hurt the euro. So we had a bit of a sideways session, though we did post a new low for the week. Taking a look at the fundamental data I mentioned, the flash manufacturing PMI for January, which is the advanced release, rose to 52.0 from 51.6 in December, but the services PMI showed a slower rate of growth as the indicator dipped from 53.6 to 52.3. The report said that some of the easing may have been a result of adverse weather and that we're still in above the 50 level separating expansion and contraction. The Eurozone economy is seeing a continued recovery. Also encouraging, the rate of job losses was the weakest for 15 months. However, since the services PMI did miss expectations, the euro was pressured by the data. So with risk aversion up in the markets today, if we take a look at the euro-Swiss franc pair, we see that we had been in a bit of a consolidation zone the last 2 weeks with support around 1.4725 and resistance here around 1.48, and we broke below that level in today's trading. So that's an important development and one to keep an eye out on. Traders would like to find out at which point the Swiss National Bank thinks that the euro-Swiss franc pair has gone too much in favor of the Swiss franc and might intervene in the currency markets. The pound-dollar pair saw a second day of declines, and which started 2 sessions ago after we hit a high around 1.6450. Overnight, we had some data that showed that the UK's budget deficit widened last month to the most of any December since records began in 1993, which highlights the concerns about the UK debt situation. Also, UK government bonds rose as stocks fell, and reports show that money supply contracted in December, which strengthens the Bank of England's claim that inflation will drop back below target without the need to tighten monetary policy. So those two weighed on the pound, and we broke below support here around 1.6250, our support for this week, and we hit a low at 1.6125. Zooming this pair out slightly, we see that that is about a 61.8% retracement of this rally that we saw starting on January 7th until we hit our high here at 64.50. So we missed the 61.8 area, but we came rather close to it. So, and as you can see, our support that we broke today was the 38.2% retracement level of this rally. In a quick look at the euro pound, we see that for the first time in 8 sessions, the pound actually lost to the euro. So right now 0.8650 is an important support. So we'll see if we have maybe a further retracement of this downside, or if perhaps today's move was enough for the market. There were a couple of U.S. releases. Jobless claims for the week ending January 16th jumped higher, posting a 482,000 figure, which was about 40,000 more than forecast. In a second report, the Philly Fed Manufacturing Index for the month of January, while still showing activity improving, it was improved at a slower rate than we saw in December. The index posted a 15.2 reading after an upwardly revised 22.5 in December. New orders and shipments showed slower growth, while the employment index did post a second month of positive figures. In a third release, the Conference Board leading economic indicators for the U.S. for the month of December posted a pretty strong 1.1% increase, which beat forecasts. The coincident index showed a 0.1 reading, while the lagging index rose 0.2%. So it's the 9th straight month that we've had positive leading economic indicators, and it points to continued improvement in the U.S. economy. Before we wrap up today's recap, let's take a look at the Australian US dollar pair. And we see that the Aussie tried to test the 91.50 area twice in today's trading, but that level of resistance held up well. And in the wake of the news from the US in terms of the banking regulations, we saw a pretty sharp slide here in the Aussie. We found support at around 89.90. That support moves back to an area that we broke above back here in the beginning of the new year. So you see we had a pretty strong break of the 0.90 area. We topped out, and now we are retesting that as support. We'll see if the news regarding China and as well as risk sentiment in general improves in tomorrow's session, or if we have a break below this level. The fundamental docket is rather light to end the week. Tonight, Australia posts its import prices data for the fourth quarter. Japan releases its all-industrial activity index. Overnight, the UK releases data on retail sales, while the Eurozone posts its industrial new orders. Tomorrow, there is only one release, and that is Canadian retail sales. And that will wrap up today's FXTimes Daily Market Recap. For more news, videos, and analysis, please visit our site, fxtimes.com. I want to thank you for watching and wish you good trading.